Hello, welcome to Tuesday with Lloyd. My name is Enya, Regional Director and National Practice Leader in Risk Management at Lloyd's US. This month marks the 1-year anniversary for Tuesday with Lloyd. This is our new way to stay connected with our clients, with our partners in the new era. Kicking off today's session are two special guests, Chris Moore, Head of ibott at Lloyd's, and Jillian Slyfield, National Practice Leader of Digital Economy at Enya. In the next hour, Chris and Jillian will walk us through their journey of trailblazing a new path of new relationship between brokers, underwriters, and clients. Before we start, a couple of housekeeping items. We encourage you to be interactive today's session, and please ask questions in the Q&A function instead of the chat box to help us stay organized. And secondly, today's session is being recorded and streamlining on YouTube of Lloyd's channel. So if you missed today's session, please share with your colleagues who can't join us today. Without further ado, please welcome Chris and Jillian.
Thank you, Enya. It's great to be on another Tuesday with Lloyd session, and I'm thrilled to be joined by Jillian Slyfield of Aon, a key partner of ours. I know someone who shares this topic as a key MO in the way that she runs her business, and it's certainly key for the way we run our business at ibott as a part of the Apollo Group. But just allow me to set the scene of this future of client engagement within the insurance setting. I left Catlin in 2012 to help set up a casualty team at Apollo in 2013. And when we left Catlin, we started at Apollo, we knew we were a big syndicate. I think I was Apollo number 14. So we didn't have that size that we could sort of source and win business. We didn't have any other offices than our London office. And so for us, we didn't have that footprint, even though we were at Lloyd's with great capital rating and great financial strength and international global licenses. We didn't have that huge company that we'd come from. So we need to really sit down and think, okay, what is going to be our USP at Apollo, and how are we going to win business and make a foothold in the market? And the major overwhelming thing that we decided was to really embrace a client-centric culture. So we really wanted to put the client first in all the decisions that we were making. And we felt if we did that, and we were willing to be flexible and innovative and listen to clients, and rather than embrace a traditional supplier-buyer model, we'd create a model where we would collaborate and co-create with our clients. And when I say clients, I mean broking partners as well as our insureds. We felt that was the key for us to make long-term, stable partnerships. And we hear all insurance companies, either on the broking side or actual insurers, talk about long-term partnerships. But I think in order to truly have those, it needs to be built off trust and transparency. And when we set up the ibott team after, we didn't set up the casualty team at Apollo thinking, we're going to write this huge, growing area of emerging risk within the sharing economy. It was actually something that was, our client-first culture meant that someone had tagged Apollo as, if you've got a problem and it's something innovative and it needs a different solution, you need outside the box thinking, all these buzzwords. It was, Apollo will listen to you, and that kind of seems to be, what they're doing at the moment. And we met this digital platform that specialized in short-term rentals, naming no names, but pretty obvious who I'm talking about. And really they came to us and said, look, we can't find a solution for this unique insurance risk we have. And we sat down and started that co-creation collaboration, created a product, that they're still buying today. And once we had done that, word of mouth spread that we were open to this new sharing economy, or now it seems a lot more broader than that. And to steal Jillian's term within her team, the more broader digital economy. But yeah, the opportunities flood from there. And we built this business that is ibott, and proud to say it'll be a standalone syndicate, 1971 in Lloyd's next year. We built it around this new and emerging digital risks. And again, it was all about that partnership model. It was all about how can we be a different type of insurer. And in order to establish that trust and transparency that I talked about, it was actually removing some of the facades that as an insurance industry we're really guilty of. And I think more so than ever, it's around pricing. Everyone knows how complex we make our products. And even when I read my own insurance products that I buy, whether it's home insurance or car insurance, it's a slog to read them back to front. And even as an insurance professional, right, we make it pretty cumbersome. We make it very, very sophisticated. And we do ourselves a disservice, in my opinion, by doing that, because we break down that trust and transparency with our customers. So our approach was very much to make our product simple, but fit for purpose. And then on the pricing side, we were used to this. A client would propose to what their risk information looked like. We would take it away and we would say, here's our price, and trust us, we're a very sophisticated insurance company. This has gone through a very complex model, and our price is X. We'd never sit down and explain to our clients, right, the price is X because of this element of your risk we think is high risk, and this element is low risk. So if you make some changes within your business, if you control this aspect, remove this aspect, that pricing can look very different. Those sort of conversations weren't happening. And that's what was breaking down that partnership model. And so that's what we've really tried to embrace as we meet with our clients and our brokers. And that has meant a huge upskill in our team as this future of digital has emerged. So lots more data scientists and actuaries, and I'll talk about later in the time that we have. And we're really going to touch on that engagement and that interaction with your client. And in order to create a partnership, you have to have a lot of dialogue and back and forth. And COVID has accelerated that. Embracing video technology and video conferencing has meant we have never before had more contact with our clients. We would do ourselves a massive disservice if after this pandemic, and I say after because it seems to be never ending, if we lose that, contact with our clients that we've established. I think we need to embrace that and encourage it and do even more. But that's my thoughts of setting the scene from an insurer's standpoint. So I'm going to pass on to Jillian, who can give us the broker perspective.
Yeah, thanks, Chris. My perspective really mirrors yours, as you know. And you mentioned the digital economy, so I'll just frame what that is for us so that it might make sense to the audience. So at Aon, I started the digital economy practice about 3.5 years ago. Feels like it was yesterday, but about 3.5 years ago, specifically to address the needs of clients who either derived exclusively out of the digital world or who had a change in their risk profile because of digital capabilities. Much of that is sharing economy, but not all of it, which is why we didn't call it the sharing economy practice. But what we learned very quickly in that client base, and now we're seeing is resonating throughout our legacy clients and traditional businesses, is that their business models are constantly changing, constantly evolving. And they're not changing and evolving every 12 months in what looks like a policy year, right? They're changing every day, something new, a different conversation, which is what makes it so exciting. And so I say when we're building out my team, I'm always looking for 4 characteristics. Although after listening to you, Chris, I literally just wrote a note down. I might make it 5. But I've been saying the same 4 for a long time, which is capacity to do the work, because not capacity like underwriting capacity, but there's a constant need for interaction. It isn't put a program in place and wait a year, put a program in place and wait 3 months and check in with your client. It's put a program in place and then the next day give them a call, right? And so, or they give you a call. So capacity to do the work. For us, it's agility. Aon's a large organization, and I know many of the people who are watching this in our audience are part of large organizations. We have to find a way of working across our own organizations as efficiently and effectively for our clients as possible. And so how can we be agile and say, this is where we need to pull in reinsurance. This is where we need to pull in affinity. This is where we need to pull in health and benefits. And guess what? Maybe we're all in a room together solving for it. Sense of urgency. So our clients are expecting things from us much more quickly than traditional clients. They need the answer immediately, not because they're impatient people, but they're in an impatient business model, and they need us to create solutions for them as quickly as possible into the marketplace, or tweak something we've already created. And then execution, right? Which is, if it's something that we've done before and we know we can do well, we always say, we'll execute flawlessly. Where we can't, we need to be very honest and just kind of work through it together. And then if I'm going to add a 5, I might just add what you were saying, which is kind of transparency or collaboration in this model. And I believe it's how we should all be doing business going forward. We're just all in it together. Like whether it's us as the broker, our clients, the carriers, we need to problem solve together and continually communicate and continually problem solve to figure out how do we make insurance facilitate the business so that it's not a check the box, it's not just a cost that you have, but it's actually a piece of the business that kind of greases the skids and helps you grow and scale. So I'm constantly talking to our clients about what is the vision that you want for your business? And then us as insurance professionals, whether it's you, Chris, and your team at Apollo, or us at Aon, it's for us to say, here's the vision of the business. How can insurance help that business scale faster, help them be more efficient? What can we do to facilitate that business model most effectively using the products and risk management tools that we have at hand? And I think that's really the key to all of this.
Yeah, I couldn't agree more on that, especially on what you talk about that 12-month cadence. It's something that obviously from a traditional setting, before I had any exposure to really that digital economy, that was kind of it. I can remember the celebration of, we've just renewed the account, we won't speak to them for another 9 months before their next trip to London, or the next presentation, or the next time we have a client update. And that would be on some of our largest accounts. And I think if the pandemic has shown us anything, if the rate that tech is advancing has shown us anything, in 12 months, a company can look incredibly different, and no more so in that marketplace type risk. A platform like an Airbnb, an Uber, a Lyft, a Deliveroo, whatever the segment, they're built on the fact that they are a tech company, an IT platform. They are agnostic to infrastructure and restrictions with employee bases, etc. So they can expand in all countries of the world. And some of their biggest hurdle is insurance. And I'm fully used to, and in fairness, the Aon team pushed me pretty hard, right? For if I ask what's the deadline, it was 3 weeks ago. If I'm asking the client, so I don't have any time to waste. And I think that's where that client engagement is probably going to see the most amount of change. I mean, from your side, and you deal with obviously a lot of carriers globally, Jillian, are you seeing that the way that brokers and the way that clients are engaging with their carriers changed already, or do you think we still have a further amount to go?
Yes, and yes. So I think there's been a lot of change. So you had mentioned in your introduction that there's more and more communication with clients. You're seeing your clients more often now than you were pre-pandemic, even if it is virtually. And so I think most underwriters would say that that's the case, is that they're getting more contact with their clients through this. It might not be what we all hope for. Sometimes we wish we could go out for that dinner, or Enya and I were speaking about RIMS just as this kicked off. Some of us, I never thought I would long for RIMS, but I'm starting to look forward to it. So to your point, yes, I think that certain things have come a long way. I think there's more flexibility. There's more collaboration than there was before. There's certainly more contact. Earlier in my career, it looked like what you described, which is celebrate after the renewal's done, wait several months. I remember putting clients in my diary so that I would call them once a quarter and check in and see if anything was going on. I can't even imagine doing that today. I mean, because the communication is so consistent that's preposterous to wait a quarter. I speak to most of our clients weekly, so it's a very different type of cadence. But I do think there's going to be another big shift. So in digital economy and sharing economy, our insurance is almost always usage-based insurance, or pay per mile, pay per minute, pay per task, pay per delivery, whatever it is. That's not true in much of insurance. But I would suggest that it should be. And so I think that there's going to be this transformation around the way that we use data and the way that we can use the context of the exposure in order to underwrite. And some of us are getting there faster than others. But my view is that if you throw the ball forward 10 years or whatever that is, that's going to be just how it's done, right? There's no reason not to do it that way. And it's a better underwriting model. And I'll extrapolate that for just a minute. If I look at COVID, it did a couple things to our client base. Well, it did a lot of things to our client base, but a couple things that come to mind from an underwriting perspective is there's a lot more volatility day to day in what's happening with each of our clients. And I don't mean like a claim volatility. What I mean is, think about what happened in March of 2020. Many of our clients either went completely into shutdown. So one large client that we have together actually globally actually shuttered for a period of time. Hibernated, came back out very strong, by the way. But anyway, so there was no exposure basis. Then you have maybe a rise in exposure base. Then as the pandemic has changed, maybe dropped off again, but you see this kind of volatility, whereas before it might have just been kind of picking up, right? And then the type of exposure that's happening is also changing. So you mentioned Airbnb earlier. If you look at a lot of the property sharing apps, what they saw is that there's no more international travel, at least for I'm talking about for during the pandemic, particularly the core year. Hopefully that's behind us, but not as much in international travel and not as many 1 or 2 days, but now you have this lengthening, right? People just wanted to get out of their houses. And so I'm going to rent a house for a week or 2 weeks and go stay there. So my point is, it's also changing the way that we see the exposure, because it might be the same total number of days, as an example, that you're underwriting, but the reflection of those days is going to be different.
Yeah, I think that usage-based model that you talked about, I think from a marketplace risk sharing economy type insurers embraced it pretty early, because it was kind of the only way to insure a hyper-growth company. I think the pandemic just showed us that how, like you say, how much volatility they had, because some of these companies ground to a halt. So I definitely see that there's more innovation that probably needs to happen around that. Jillian, there's a good question that's come through, and something that we discuss as a team quite a lot, from Anthony Joseph, talking about with new clients asking for insurance, and essentially what they're asking is, they put a big draw on your team, they ask you for so much. How do you manage that within your team with all that additional labor to do that more frequent engagement?
Very carefully. Well, so what we've done at Aon is, because this particular subset of clients works at a different cadence than all of the rest of our clients. And I think the one that it looks most similar to, interesting enough, is our mergers and acquisitions team, where they always call it deal time, right? And so I say our team is always on deal time too. And so at Aon, what we did is we actually have a dedicated team specifically for this business. So dedicated account executives, account specialists who work alongside the account executives, dedicated broking, salespeople, business development. So we don't have one of each inside of Aon. So I affectionately call us a neighborhood inside of Aon, which means we have porous walls in our neighborhood. We have our core team that's built around the cadence of a digital economy account. But we have no problem reaching into the broader organization. And in fact, maybe I shouldn't even say it, no problem. It is how we operate, to reach into the broader organization for the tools that a big company like Aon can provide our clients. So, our clients don't choose Aon because of Jillian or because even of our, smaller core team. They choose us because we have 50,000 colleagues who are, strong specialists in what they do, and we want to deliver the whole firm to them. At the same time, we've learned in this particular type of business, we can't do it the way we used to do it. It just doesn't have the same kind of that same capacity, agility, sense of urgency, execution, right? So we had to create a different model.
And I think that's a very similar story to us, right? When we looked at it, okay, what is our client engagement going to be like? We wanted that client first culture. The biggest thing that we wanted was, it wasn't just an increased frequency of engagement. Yes, we want to speak to them weekly, monthly, if we can, to keep update on how dynamic their business is, and constantly testing ourselves to say, okay, if they're growing here, if we're growing there, if they're expanding into this operation or that operation, is our insurance product still fit for purpose? A good delivery would be, if delivery companies that have historically delivered with motorbikes and mopeds and cars are suddenly transitioning to e-bikes and e-scooters, you're looking at an auto coverage versus a general liability coverage. How does that affect the insurance program? But it wasn't just for us about an increased frequency engagement. It was a lot about a deeper engagement. And I've seen this absolutely within the Aon team and the way you structure your team. But we started looking at, okay, is it just underwriters we need? We need some different skill sets. And we started saying, right, the amount of data that we're looking at, we need data scientists. The amount of complexity in these risks, the amount of premium they can generate because they're large, complex risks. We need a dedicated actuarial team that are going to live and breathe this usage-based insurance and the unique risk factors that we're looking at. And so our team looks almost very different to a traditional team. We have less underwriters and actuaries, and actually some of the underwriters in our team are qualified actuaries. And for us, it was no longer is it the lead class underwriter is the king of this business, and that is the only person who will ever meet a client and will ever speak to the broker, and the relationship purely flows through them. And I think from a London perspective, and I might upset a lot of my friends by saying this, that has been the traditional way, is that the underwriter is the king and rules the roost somewhat. And that's why, there's large gardening leaf packages in London and things like this, because they really do own those clients. For us, it was about, we need a flat structure, and I need my client having engagements on the claim side, the underwriting side, the actuarial side, data engineers meeting with our data analysts. And when you have that engagement across those different skill sets, I think the partnership just becomes much stickier, and you get so much more out of the partnership. I am not qualified to speak about the intricacies of data and how we can share and build APIs and all this sort of thing, but I have experts in my team who I have full trust that they can do that with a client. So, lots of people talk about, okay, we'll just meet our client lots more. It's about meeting your client on different levels, discussing the different aspects of these risks, and putting that all together to have that holistic partnership. Can sometimes be out your comfort zone, because you need to keep on in charge of, right, what have you said to who, and what are these discussions? Have I been involved in all of them? But it is a way to answer Anthony's question, to distribute that workload amongst other experts in with your team. It's connecting experts with experts is what a lot of our clients, and I know the Aon team and the Apollo team talk about a lot. Just a distribution of skills. Absolutely.
I think we work outside of our comfort zone daily. And it's a prerequisite for the job, right? I mean, we have to. I listen to a new business model almost every day, and it doesn't mean that it's transformational, right? But it's a twist on something we know. Sometimes it is transformational, and we get, have you done this before? No, but we have a process to do it, and I feel very confident in the process and the people behind it. Right? It isn't that we have to have a cookie cutter approach. In fact, it's absolutely the opposite. It's not about, I'm about to say this to an underwriter, it's not about the form. Of course, it's about the form at the end. But I mean, it's not about having a special widget that you plug in. It's about creating a customized solution for each client's need to facilitate that business. And so I think you're right. We work outside of our comfort zone. The other thing you touched on is that kind of trifecta, right? Claims, underwriting, and actuarial. And I saw in the chat that there's an actuarial student who's listening. So I would say, earlier in my career, I very rarely worked with our actuaries. I mean, we might do it for it. It was common, but it wasn't in the forefront of the business model. And today, it's literally daily. Our clients often hire actuaries before they hire risk managers on their teams. If not, then it's the number 2 hire, risk manager, and then actuary. For us, we have a dedicated actuarial team for digital economy who works inside of Aon, who's kind of the other side of that coin for me and for my team, again, reaching into the neighborhood inside of Aon. But that's such a key piece. And you and I, Chris, have talked about this before when we're thinking about data, but we need each party, yours, our clients, and us as the broker, to come to the table with an informed thought process around data and how to use it to underwrite the business. It's not I'm going to get a number from you and I'm going to get a number from somebody else and I'm going to play it against each other and see who's cheapest, right? That's not the game. It's like, how do we get the best, most efficient number that matches with the data and the circumstance? And each one of us has a portion of the information necessary to do that. And let's bring it together and solve for it. And I think that's the one piece, if I were talking to clients earlier in their life cycle, I would say, get the data right. Like that is the critical piece that we see through this that is often challenged in the process.
Yeah, I could not agree more. I think we spend a lot of time today in the engagement with our clients talking about a memorandum of understanding in terms of the data. And I think that's what, if I was giving any advice to any brokers, clients, it would be, that classic submission time frame that you get, in the submission or in the presentation with a client. Hey, here's our timeline. We're going to meet the market, present our information, have some client discussions, quote by this deadline, and we're going to bind by this deadline, right? There's a whole missing step that's before that present to the market that really needs to be, you need to engage the market, invest in knowing for them, what is your appetite? What do you see as the key pillars to our risk? What is the data points that you need to see? Let me go back internally, collect all that data in the most easy, presentable format that I can give you, because when I come around to that presentation, I want to make sure that you have all the information to give me that, that broadest view of our risk. And I think it is a misconception sometimes to say, oh, the more you give to an underwriter, the more they use it against you and all these sort of things. And there's a lot of, oh, be careful what you share. For me, if there's not pure transparency, then I have trust or I have uncertainty, and uncertainty means higher pricing. I mean, sorry, that is just the way of an underwriter mindset.
Right. I mean, it's what you have to underwrite to, right? You've got to underwrite to the data. And as I tell our clients, you're also underwriting to the risk management mindset, right? Are there, skilled people in the executive positions? And skilled doesn't mean you have to have 30 years of experience. We work with a lot of people who are earlier in their careers, but people who've got strong consulting around them, skilled people, strong data set. Again, it might be an early data set, but thoughtful about the collection of data and how it's used, well-funded companies. And when you get them and they come to the table, you've got a really interesting client to start to do business with. And you're right. I mean, your tool is to either decline the account, right? Or to add cost to it, because your job is not only to write new business, but it's also to protect your company, right? And so, that there's two ways to do that. There's either don't write the business and just write what's extremely safe, or charge a lot of money for it, or get enough data where you can have an educated thought process and a reason for pricing it at a more efficient or lower price, right? That makes sense.
Yeah, completely agree. And I know, and I think the reason carriers, and we'll get a bashing sometimes for asking these huge laundry lists of questions, laundry lists of requests. And, I've heard this called a lot of things, but I think the failing there is that we're not showing that trust and transparency to say, this is why I'm asking the question. This is why it's meaningful. Let me tell you why I'm asking to see developed triangles, or why am I asking to see this particular metric. And if you share, I think there's something in this, we want to test this assumption. And it may be something that we use in the underwriting process now, or it may be something we track over time. But what we're trying to do is build something within your model, or the way that you're priced, or some additional rating factors that allow you to make better risk-based decisions. And if you picture like that, then a client will be like, well, I'd be crazy not to supply this particular information or this particular data set, because there's a mutual benefit to everyone in the value chain. But if we just send a list of, here's my 20 questions with no narrative around it, with no guarantee that this company has an appetite or actually really wants to write the risk, etc., then I can understand the frustrations and reluctancy for brokers and clients to have that engagement.
Yeah, there's no question. So one thing I was going to ask you about, because you and I have, I think, similar thoughts on this, is 12-month policies. So I think, so I'll kind of lead into it, which is,
sure.
I would say more than 90%, if not closer to 100% of our clients have a 12-month policy. And a policy is obviously designed to be a contract between two entities, the carrier and in our case, the client. However, with our clients in this space, in digital economy specifically, and then I think the pandemic has had this show up for clients well outside of the digital economy. What you thought was going to happen on day one, now you're into day 75 of the policy, or day 180. It's a very different picture, and the policy no longer reflects what's happening in the client. And sometimes, frankly, that's just due to growth. It's not even anything bad that's happened, right? It's acquisitions, it's growth, it's growth into new geographies, new business models, et cetera, et cetera. And so one of the things I think that you've done well that I'd like to have a conversation about is, like, how do you think about midterm changes, even cancel rewrites, or any kind of like meaningful change? I'm not talking about like an add delete kind of thing. I'm talking about like a wholesale change in a policy midterm.
So if I had to sum up the ibott mission statement, it would be data-driven underwriting. And so for me, if you get the data right, and you get that data on a maybe it's a weekly, live, monthly cadence, and it's empowered by an API that gives you a really granular data set that you can spot trends and emerging risks, et cetera, then the ability to underwrite between that 12-month cadence to actually, and again, I think data, we always think about what data can we ingest as an insurance company, right? One of our mutual clients, Jillian, as referred to insurers as data vampires, right? Yes, we love receiving data, and I will never say no to anyone that wants to share me data on pretty much anything. But it has to be a two-way stream, right? We have to be able to give back to our clients and say, on this data that you've sent me on this monthly cadence, here's your health check report, or here's where I think you are. versus your expected loss ratio. So these clients can then budget and know what their rate change would look like at the end of the year, but they can also empower them to say, right, okay, if it's an auto heavy risk, we've grown within drivers in a certain cohort that Apollo feel are riskier. That's driving our loss cost, and they think we're above where they would expect us to be. You can make a business decision during the policy to correct that, to bring your sort of loss cost into expectation and not be subject to a rate change. For me, that's even more important in a hard market. A lot of people, when I first entered this industry, and it was, if you can get a 2-year deal or a 3-year deal, it was the most amazing thing in the world. For me now, when I deal with this digital client, I say, I don't want a 12-month policy. Why do I have to have a renewal date at all? Can I just have this evergreen policy that as soon as we give each other a certain notice of cancellation because the relationship isn't working anymore, then let's do it. But I think if you exercise that flexibility, that if you've got that partnership, that you have that back and forth ability to innovate, cancel, rewrite, create changes where they're necessary. And that, again, is only going to happen if you've got that engagement and alignment on the way that you're seeing risk. I think you'd be doing everyone a disservice if you're waiting for 12 months to go, oh, great, you're up for your renewal date. Here's my fresh wave of innovation that I can offer you and all these bells and whistles. It doesn't work like that. Again, that's a supplier business model, supplier buyer. We're talking about a collaboration, co-creation. I want my insured to feel as much ownership over the policy and the way it's structured and the way it's rated as I do as the insurer. It's our product, right? We're all in this partnership together. I think I've danced around your question there, but...
I think that's a great answer. And the other thing that it made me think about is it's not just data, but insights, right? There's going to be certain things that I've seen this happen several times where our client sees something in the data that you haven't seen yet and I haven't seen yet. And, or I should say our team hasn't seen yet. And our client raises their hand and says, hey, we're noticing that there's a claims uptick when X, Y, and Z happens. Or, hey, actually, we just rolled out a new generation of scooter, a new type of shared ride, something that's happening. And we're watching claims drop in this space. Or a good one was when the pandemic happened and we said, wow, there's so many fewer people on the road. That should mean lower frequency and lower severity of driving claims. Well, it's not what we saw, right? And it was, at least for me, it was our client who said first, yes, of course, there's lower frequency because there's so many fewer people on the road. But the people that are on the road are driving like, I was going to say something I shouldn't say in a video, driving very, very fast. And so now all of a sudden we're seeing some of the severity pop up, right? And so they flagged us to that first. And so I think sometimes it's the data, but also let's work together on the insights and then say, okay, wow, okay, as a team, how can we help solve for that? Not just through insurance products, but what are the risk management tools that we have in our toolbox as well to help them through this?
And to give another example of, again, data-driven underwriting decisions and trends emerging that when you look at just the data, impossible almost to decipher what is going on without that engagement with the client. We've insured a lot of on-demand delivery companies, which everyone on this call will be very familiar with during the pandemic and sure have used them many times, right? What we started seeing that there was a frequency if we were working on a per delivery metric, so a usage-based metric, and that's how we're pricing our product. And we were working with our actuaries, and we were seeing a frequency uptick, nothing to do with COVID, but every year we're seeing this frequency uptick slightly on a per delivery metric. And it was really difficult to understand. We looked at, okay, is it to do with the driver cohort had staying pretty stable? Was it to do with the territory of the deliveries that were also pretty stable? But what we'd seen was that the engineering team at this particular delivery company had invested huge amounts in the tech to try and help route optimization. And so for them, it was the quicker I can make the delivery, the less mileage per delivery, the better I can get. So, utilizing batching and just getting better at the dispatch. So what it meant was in 1 year, we may have had 4 miles per delivery. And then you fast forward to the next 12 months and it's 2 miles per delivery. Well, all of us who underwrite auto or motor, or even if you don't, it's simple to understand that the most dangerous part of any journey is starting and ending. So it's pulling out into the road and pulling off the road. Well, when you go from 4 miles to 2 miles, each delivery, is having that different metric where you've got more pickups and drop-offs. And so that's where we shifted to that per delivery metric, because per miles, just made it really volatile. So I think even within the data, it's impossible to pull out those trends unless you're speaking to the client to put that narrative behind it. And if we'd have found that out from the client, we could have easily said, if that's what you're trying to do is reduce the number of miles per delivery, then per mile isn't probably the right metric for you. We need to think about a new metric. And we would have been better positioned if we'd have made that change earlier in the policy than have waited around to the renewal and found out and said, do you know what, we modeled this wrong because we didn't see that shift that our client was trying to make.
Yeah. I do think the year goes fast. That's part of the problem.
Yeah, really fast.
I feel like as soon as we put one of these to bed, we're already working on the renewal. We do kind of a debrief, and then we say, okay, how are we going to manage whatever's happening in the coming year, the growth, the scale, the changes, and it's certainly been more intensity. I would say it's the same type of work that we had been doing for the last 4 years in the practice, but the intensity of it, particularly over the last 12 months, has increased substantially, particularly around the things that you're talking about, right? Like what's changing, and then how do we make sure that the insurance program, and when I say that, it's both coverage, but it's also for us, it's the risk management tools. Are we using risk consulting properly? Are we bringing actuarial in at the right time? Are we bringing claims in at the right time? So it's all of those tools. Like, are we using them fast enough? Are we seeing the insights quickly enough to kind of jump on it and help them change their risk profile before it goes sour?
And that last thing you just said, just a key point that I have to get across is, it's easy as an insurer and an insurance broker to get caught up in our own world when we think about the data and just think this is all about controlling pricing and controlling volatility. I think if done well, to your point, it can enable growth, right? And it can empower our clients to make better risk decisions, which, the romantic side of me would say, which makes us a safer world, a safer economy, a safer business, right? Which ultimately is the most fundamental important thing. If I can give the insights to say this particular type of risk is the high risk within your portfolio, and this particular risk is a low risk portfolio, maybe that's, in a home setting, do we see the majority of our claims come from things like swimming pools or balconies? Do we see the majority of our auto losses tend to happen when there's a bus lane on that particular road, or there's a cycle lane or a lack of a cycle lane? If all of a sudden we say, right, we can share these trends with our clients, so this is where we're happening, that empowers a lot of different things. One, you can either try to eliminate those and look at risk-based routing, right? For the auto setting, we're not going to do those. Or you say, okay, for that particular home rental that's got some of these high-risk characteristics that we can see in our data, can now we do things in-app to control that risk? So you might say, hey, there's a swimming pool at the location, here's the best thing, here's best practice, you're reminding that person. So you can have that active, live, dynamic risk management, if done well, that you really use this data and it's something that flows through the app. I'd really believe that any company that's buying insurance is, hey, it's balance sheet protection, it's behind the scenes, it sits as a separate function within the business. I think if you flow that whole risk management throughout the business, ultimately leads to huge results.
Yeah, I think one of the things I see with our clients is, first of all, we look at insurance can be a proxy for trust. So if we have a new business model that's coming out, and as a consumer, you're considering, do I stay in someone else's home for the first time or not, rather than stay in a hotel? Do I get inside somebody's car for the first time to take a ride, or do I just grab a cab because I'm used to that, right? Some of those things that now we think of as an everyday occurrence and it's no big deal. But at the time you thought, really, I'm going to get in my neighbor's car and go, what is that like? But knowing that it was insured, and it was part of why, if you look at TNC specifically, why the TNC laws were passed, it made us as consumers feel more comfortable with the ride. So how can we create that same environment, that same trust using insurance products to help new business models grow? So I think that's part of our challenge in our job. And then you were also talking about kind of coaching our clients, particularly, I would say, not to put words in your mouth, but my guess is it's particularly when they're early stage and mid stage, as they become kind of at scale and high growth, it's either more from them to us, or it's at least balanced out. Early stage, one of the things I find so exciting about working with clients in digital economy is how coachable they are. Our clients come to us and they say, what do you want us to do? We're building our company. We know you need data. What data do you need? We're building our company. What are the insights that you see? right? How can we make a better company based on what you've learned, Chris, what I've learned from having clients in the space? I know, I'm proud to say Aon's the market leader in this space. And so we often have clients that come to us because they say, as the market leader, you see across the industry. And so what do you see? Like, help me so that I'll make those same mistakes, right? And in other business models, I hadn't always seen that type of coachability early on around insurance specifically. And I think it's largely because the broke wasn't so forward. I mean, so many of our clients have like their insurance policies on their websites, which is it's common for us, or at least a summary or some kind of reference to the insurance, right? Common for us, not so common in traditional business. So I think there's an element there of how do we work together when you have an early stage business, because you can actually develop their risk management program in coordination with them in a way that other types of businesses might not have even thought of at that time.
And that's where I've had to really put a new perspective on who my clients are. Because traditionally it would be my insured is my buyer, my client is my broker is my sourcer of business, they're my intermediary, they're my gatherers, right? My hunter-gatherers to bring that business towards me, because we're very much an intermediary model. We don't do direct business. And so when you look at that, that was the classic, they're my segregations, they do that, and Aon and Marsh and Willis and others do this. But then throughout this evolving landscape, certainly within the client side, when they start using trust and they look at insurance, they start to say, well, actually, this could be a different business model for us. Can I administer insurance and distribute insurance products for my insurers to my clients and my marketplace, right? So if someone's interacting with a short-term rental company, can we sell them travel insurance? Can we help them with their standalone home insurance? If you're a driver for a gig economy, and that's pretty much what you do, what do you do when you're not working for a gig platform? How does that insurance work? Can I build trust by creating other insurance add-ons? Never more so than, sort of some of the occupational accident coverages that the platforms have purchased in the US. So I've had to really think of my clients all of a sudden as, yes, they're my insureds, but they could be my future distributors of a huge amount of products. So collaborating on future products with my clients is, for me, somewhat different, but actually something that's really super exciting. And then on the broker side, I've seen huge investments within your organization, absolutely, on we need to have more tech to help our clients. And so I don't see you just as a sourcer of business now, but more of an enabler, right? I might not necessarily have the tech to do a policy that administers individual policies to individuals with per hour, per day. So with investments like Aon made in things like CoverWallet, all of a sudden I look at you as a tech vendor, as well as a broker, as well as a risk consultant to our clients. I think everyone's roles are changing to that wider perspective of risk, and it just engaging with different entities for different things is just becoming the norm now for us.
Yeah, I think if I think of my underwriting days, I hate, this is so almost embarrassing to say, but I think I used to come at things as like, no, unless. So I'm not writing this unless I see X, Y, and Z, right? And now when I look at my job and when I look at kind of underwriters like yourself who are really cutting edge and thinking about not only our clients differently, but the tools at our disposal differently to serve our clients, it's yes, I have no idea in the moment how I'm going to accomplish yes. Doesn't mean we can't do it. I just mean there is not a set path to get to yes that's extremely clear. It's not 3 steps and we're there. It's, okay, the answer is yes, we can do it. Now let's figure out the best way to do it for you. And that might be, by the way, if I'm looking at it from an Aon perspective, that might be inside my team. That might be inside of Aon. If, to your point, we own CoverWallet, we work closely with them. So it might be inside Digital Client Solutions of Aon. And it might not. It might be, hey, there's this really cool insurtech company over on the side. Let's work with them to facilitate business on behalf of our clients. But the answer has to be yes. And then let's find the very best tool in order to get there. And that, my experience so far is that whether that ends up being Aon's channel or a third-party channel, if it's in the best interests of our clients, we all win at the end. And that collaboration has built a lot of really interesting partnerships and revenue streams, for our carrier partners and for ourselves.
Yeah, could not agree more. We've got about 50 minutes left. I think there's quite a bit in the Q&A for us to go through. So maybe I'll start at the top. I'll be directing most of these to you, Jill, and then I'll add in
Sure. Oh, I didn't see the Q&A until just now, so that's good.
Okay. So a couple of examples how insurance can be seen as an enabler to business. I think, Jillian, you've probably touched on that with what you're seeing is certainly within a sharing economy setting, right? I think we talked about my prized possession would have been my home. To allow a stranger into my home to rent that for me requires a huge amount of trust. And I think what a lot of platforms try to do is use insurance as a part of that trust, right? Just to say, hey, if anything happens during this rental, we're going to remove that hurdle that you have to source this insurance yourself, because most insurance is still a pretty lousy customer experience. And these platforms are trying to, absolutely disrupt that. Is to say, we will provide an insurance program that will cover you within the terms and conditions, obviously, for anything that happens during your home. So that will allow more supply in the platform, which will ultimately drive more demand. So that's an example of how these platforms are creating trust. Don't know if you want to add anything to that, Jillian.
Yeah, I think the one thing that comes to mind for me, and I think kind of skimmed this, but I saw the word regulation here, which is for new business models, and use it, whether it's home share, ride share, and many, many others, the regulatory environment, which is often evolving because there isn't, if you go back 10 years, there wasn't specific regulation, as an example, for ride share companies like an Uber or a Lyft. And so the regulation had to be made, but the insurance had to meet the regulation. So the insurance had to be created at the same time the model bills were being passed, so that as soon as the bill was passed, the insurance could go into place and the business could operate. If not, then one of two things would happen. Either the bill wouldn't get passed because there was no way to meet the requirements, or the bill would get passed and the business couldn't operate. And so that's an extreme example. We have another client who was looking for a way, their micromobility company, looking for a way to differentiate themselves in the European marketplace because they were seen as being a little bit dangerous, frankly, but just this unknown, this fear of the unknown. So we put a passenger accident program in place for anyone who's riding a micromobility element from that particular company across, I think we had it in 14 countries in Europe. So if you put something like that in place, all of a sudden they started winning RFPs across Europe because they had something that the European governments felt was protecting the consumer and probably protecting the social medical system as well. So that was another win.
The next question is more of a statement from somebody, but saying an experience with London seems to be the focus is on rate online and rate increases. And I don't want to just answer the easy questions. I'm happy to tackle a difficult one. I think there's obviously hard market conditions at the moment, and certainly within the casualty space, I think social inflation and some other trends are quite difficult, and there's uncertainty there. I think insurers are trying to protect them in as many ways as they possibly can, and a lot of that will be in rate increases where they've had some years of poor performance. But my advice to a client, a broker, engaging with the London market and any market, because I think this is universally across the casualty landscape and really all lines of business to some degree, is really take ownership to really pad out your submission, as we've said, with the right information. Engage with your insurers early. Talk to them about, okay, where are you seeing losses? Where are you seeing trends in your loss activity across your portfolio? And really focus in on those exposures within your own organization to say, okay, what risk controls do we have in place? And really hamper in on, I want to share every piece of information, every piece of data to support you, to make you as comfortable as possible with the risk that I have as my organization. And if you do that, you can separate your submission to others in the market. And I think that's the only way you're going to have a chance of achieving a result that's outside of a portfolio underwriting. Certainly we take a manuscript approach and a unique approach to each of our clients, right? No one client's the same, and the data looks very different. Their operations very different. So we underwrite them all very differently. But to do that, I need that information to be able to differentiate. So it is a bit of a catch-22. But yeah, I think if you invest in that presentation of information and data to your clients, you ultimately get more for it, and you get that back. So that would be my advice. And Jillian, I don't know if
I mean, you said it perfectly. The only additional comment I would make is for clients in this space, I often see them using other kinds of alternative risk transfer tools earlier in their life cycle than other companies. So just use, the simplest one is a captive. So I'll just use that as an example, which is, I think our clients in this space use captives for innovation rather than for risk that is known. So clients in other space say, I want to insure the risk until I can see exactly what's happening and where the stability points are. And then I'm going to take the volatility out of the market by putting it in a captive because it's a known risk. In our client base, they say, this is an unknown risk. And so I'm going to prove to you, Chris, that I believe in my risk and that we're in it together. And I'm going to take part of the risk and you're going to take part of the risk. Or I'm going to take all of the risk or 90% of the risk and you take 10%. And then 5 years from now, I take 50% and you take 50%. It's an inverse to time. Like the exposure is inverse to time relative to our clients in a more traditional business model, which I think is really interesting. So it's kind of almost literally putting your money where your mouth is. Right. So we just use different tools, but that transparency that you're talking about is really key.
But I think when a client comes to us and it is something that our largest clients do, what I love about that is the alignment. And what I love about that is then that engagement, because when they say, well, wait a minute, I've got skin in the game now. I've never had a client more engaged. Okay, right, let's get to the granular of this data. What trends are you seeing? What trends are we seeing? Because this impacts all of our balance sheets. And I think that has sourced some of the best outputs that we've had in our actuarial teams and our data scientist teams. And it's great to watch those guys engage in that really deep engagement. But I think the concern for many insurers is, okay, at what point do they just retain it all and walk away? Well, for me, it's all about, well, that won't happen if you continue to add value as a partner. You've got to continue to be immersed in your product. No risk is going to stay the same. So that data will very quickly become out of date. And as an insurance industry, we see that entire spectrum, like you were talking about, Jillian, as Aon being the market leader. You see this wide spectrum of all different classes. And we can learn and bring those trends from a wider industry perspective into that individual client. So as long as you trust that, and you're transparent and you're adding value into that chain, there's no reason for them to remove you. It's just an ability of alignment. So I really like when clients quote share a risk with us.
Yeah, that's interesting because I have the same perspective when clients want to use an InsurTech for a part of their business. Don't get me wrong, I'd like Aon to serve as many functions as possible for our clients. And I think that the more that we can see across their business, the more value we add to each piece. Having said that, we also can't be, this is the entire world of insurance and nothing else. If there's an interesting solution with another partner, I would rather work together with our client and that partner for a longer term solution than alienate my client or not even have a view, not be able to see or have perspective on that other part of the business because we've walled it off. It's just about working together.
Completely agree. Okay, a couple more questions. Yeah, there's a lot that I don't think we're going to answer all of them, unfortunately. Oh, that's a very good question, and quite a pertinent one for me. Have you lost any established clients that you have built a strong partnership with to more traditional solutions? I'll let you answer, Jillian. It's a bit raw for me post 1-9.
So I always say I'm going to be a really crabby person when this happens, but so far as a practice, we haven't lost a client. And every time I've said that out loud, I'm like, oh, it's going to happen today. I'm going to jinx myself. But no, I haven't seen any clients. In fact, I should ask his permission if I can use this, but a very traditional risk manager who worked for a company, he's been a risk manager maybe 25 or 30 years in a very traditional industry, is now looking at usage-based insurance. And we've done a product for him on a part of his business. And he would be the first to say, and he has said it to me, that when somebody first started talking to him about usage-based insurance and the way that we now underwrite this program of his, he's like, he didn't think it applied to his business. Again, a really traditional business model. Didn't think it applied, didn't see the use case of it. Now that we have this other program in place, he's like, there's no other way to do it. He's like, now that I see how effective these programs can be and how malleable and flexible and the communication, and this is the way we need to do all of our business. So he's like, he's really had a paradigm shift in the way that he's thinking about it. So I think it's like upgrading your phone. Like once you get to the new stuff, you just simply can't go back. Like it's new technology, and going backwards just isn't in anyone's, first of all, it's not been in anyone's best interest. I think they found a better outcome from it. So there's more value there, which of course is going to drive the purchase decision. And because of that, they don't go back.
So unfortunately for me, I have lost some business, and that's natural, right? The one thing I would say, you can't have our cake and eat it, so to speak. We have to live by the sort of principle that we've had, which is partnerships, trust, transparency. There are occasions when a more traditional carrier will want to enter a pretty innovative space, and will do so with a traditional product. And there are aspects of traditional products within sort of the remit that I look after that are hugely attractive, and there's reasons why we wouldn't be able to compete on that basis, because it wouldn't make sense. So to one key example would be a usage-based product is required, in my opinion, for a hyper-growth company. If you've got a flat non-auto program and you're insuring a hyper-growth company, then it doesn't matter what how accurate your pricing is. That's obsolete if that company grows to a certain point. But that being said, I have a lot of respect for the people involved. I'd like to think a partnership doesn't end because we don't write the business for 1 year. We'll keep in contact with that client, and we'll sort of reapproach it as and when that traditional carrier, I suppose, will either transition to a usage-based product or will stop wanting to write something so volatile, because it's difficult with companies, like I said, that are asset agnostic, that can grow pretty rapidly. So we have lost it. I think ultimately it comes down to just, again, you just keep the doors open for future collaboration in the future, and hope that client comes back and will want some of the innovative things that we're doing at subsequent renewals. So it has happened, unfortunately.
So there's a question here about how much competition from insurers other than Lloyd's in this class of business. So Lloyd's is definitely at the forefront. There's no question about that. I think from a primary basis, there's a lot of competition and some really good competition with very thoughtful underwriting, creative underwriting, new solutions to the table, again, a collaborative mindset. I think we've got strong competitors there, but there's a gap certainly in anything that's kind of anything past primary, wherever you want to end your primary. But I would say certainly in the X of 5 category, if you're trying to fill in a 10X of 5, 20X of 5 for a client, it's a desert. And it's an interesting desert to me, because at this point we've got so much data, and Chris, I'll use my term because I can't speak without using my term. We don't always have our long data. We might not have 10 years of loss history to bring in, but you've got this deep data, which means you have so much information about every point of transaction. I'm not saying it's easy to underwrite. I would not say that at all, but I would say we can underwrite effectively in this space, given the tools that we have today. So I would love to see more carriers participating. But in the meantime, and hopefully well into the future, I should say, Apollo in particular has been an extremely strong partner for us and for our clients.
I'll just end it with a touch on that. The limits required for platforms as they grow to certain aspects, the different things that different carriers bring, right? So, from a Lloyd's perspective, we don't have admitted paper in most cases in the United States. I think there are great collaboration opportunities amongst insurers as well. This isn't every insurer in isolation must compete. And, I do think there's partnership opportunities between different insurers that have different skill sets, different appetites. We certainly have some of our strongest partnerships are with our reinsurer and with our capital providers, and they have their own insurance operations that we partner with in certain territories to create unique solutions. So, I speak a lot to different insurers about potential collaboration. And as long as you stick to, this is what I'm really good at, but I know what you're good at, I think that trust and transparency can absolutely happen between insurers. And from a Lloyd's perspective, syndication is something that's in our DNA. We quote share risk with other Lloyd syndicates all the time. So there's partnership opportunities between insurers, not just with clients and brokers. Now, Enya's come on. I know she's going to tell me off and tell me to stop speaking, so I'll be quiet.
Thank you again, Jillian. Thank you again, Chris. We could not say thank you enough for the exciting session you gave us today. And I heard the keywords: collaboration, partnership, trust, transparency. Will come off your comfort zone. These are just a few keywords I gathered from your insight. And again, thank you. And for next week, please join us. We have exciting session next week lined up already on private solutions. We're going to feature a few leaders innovation from Munich Re, from Token Room Kyung, and from Score Channel Syndicates, as well as Lloyd's Lab. So join us next week. In the meantime, let's stay connected. Thank you again for joining us today.
Thank you.